Well, let's get across the market open now. Brad Walsh joining us from Macro. Brad, welcome. Of course, all eyes and response to what we've heard from Donald Trump. No country has escaped. How do you view what we've heard?
Yeah, thanks for having me on. Well, the Aussie futures are pointing to up 0.5% open at the open, but obviously that was following a positive session on Wall Street. However, I think these gains are going to be a bit short-lived due to the fresh tariff tensions we're getting out of the US. I think, President Donald Trump, or tariff man, as I like to call him, has announced a 10% baseline tariff on all countries, which is less aggressive than feared. But they're definitely more targeted punitive tariffs, which were announced. So you got the 34% on China, 24% on Japan, 20% on the EU, and then the Australian beef industry was specifically singled out, raising concerns there. Notably, though, Canada, Mexico were excluded. That did push their currencies higher, and I think we're in for a bit of a volatile session ahead of that.
Indeed, you would think so. Yeah, so as you mentioned there, he did single out Australian beef exporters. So obviously that'll be on watch for any related companies involved.
Of course, and I think, there could be some opportunities coming out of this. It's definitely one to watch for the moment.
All right. What about those second order effects, particularly given that China has been hit with a 34% tariff rate, and given our reliance on China, how that's likely to affect us, do you think?
Yeah, look, I think it could be an opportunity for us. I think as China look to export from or import from other countries, so hopefully we can pick up some of that from the US. So I think, we're in for a turbulent time, but in the short term, but maybe longer term, it's positive for the Aussie market.
All right. So Brad, of course, the key question for investors is how you position for this. What are you doing there in Macro?
Yes, look, we continue to maintain sort of a defensive approach at the moment to portfolios, obviously preferring exposures in gold, hybrids, and we've a high position in cash. While we do continue to monitor this geopolitical situation that's playing out, and what impact that has on the portfolios, some visibility around the tariffs and global trade wars have obviously will hopefully be, maybe not today, but welcomed by the market, and we can get a bit more visibility. Obviously, investors, especially on the institutional sides, continue to remain sort of on the sideline and sucking a bit of liquidity out of the market, and they sort of, before they sort of get back into the market, they like to see a bit of clarity before how they proceed ahead. So, however, we are preparing names to deploy capital in when the market stabilizes a bit. We will probably continue to focus around high quality businesses with strong fundamentals and the cash flows that sort of have clear competitive advantages and costs. One we do like, we continue to prefer for our clients, which you obviously got in heavily at the back half of last year, is PM Gold. It remains a cost-effective and secure way for Australian investors to gain exposure to physical gold, which continues to reach new highs. Obviously, that is backed by the Western Australian government and fully redeemable for physical metal as well. And it's sort of, the PM Gold just combines the safety of allocated gold with the accessibility of an ASX listed security, and obviously continues to outperform the market, providing us a great hedge against this volatile risk-off market. And it's just something we prefer instead of holding the miners, given sort of their idiosyncratic risks that they have with operational headwinds that some of them may have from time to time.
Brad, what would you be avoiding at this point, or perhaps looking to sell?
Good question. I think, personally, I think the banks are overvalued. I know that's a bit separate from the current tariff talk, but it's definitely some. People seem to like they're flocking to the banks for the safe haven, but that's just raising sort of equity multiples to ridiculous levels, in my opinion, especially looking at them versus sort of some of the global peers.
So, Brad, overall, you're expecting some sustained weakness in equities?
Yeah, look, so I think for the short term, especially, even though the market's now pricing in sort of 4 cuts in the US over the next 12 months, yeah, which has been obviously pulled forward significantly since the start of the year. And obviously, you're seeing downgrades again from Goldman Sachs, people like Goldman Sachs, which is downgrading US GDP, and obviously I like to talk about US GDP because it obviously, and US economy, because it does fall over to global markets, and obviously more more closer to home with the domestic here. There's been a flag of sort of corporate earnings, and starting with the tariffs and weak economic growth, increased inflation. These all sort of increase in the risk of a US recession, which is and the other a buzzword that's being thrown around is stagflation, which is obviously a difficult market, but that poses new opportunities and different ways to position. And we're also seeing a bit of a mixed picture out of the US on the jobs front. So we've seen last week we've got JOLTS data, job openings was weak. That was largely driven by the sort of federal layoffs. However, yesterday we saw good numbers in the private sector payrolls, which came in stronger. So I think it'll be interesting to see how the non-farm payrolls come in sort of back end of this week. And yeah, but we're starting to see credit spreads widen from historical lows, and obviously the US 10 years taking a bit of a hit this year.